pounding on the table for my team. Every night I flex, I'm making big moves.
Ladies and gentlemen, welcome back to another episode of Pounding the Table. In the past few weeks, the world feels like it's burning a little bit. We got Afghanistan in a very unfortunate spot. We got the Delta variant going crazy. Yet the S&P has crossed the 4,500 mark for the first time earlier in the day. The yield on the benchmark 10-year treasury has now climbed to 1.34. So things are kind of going all over the place. And we're joined here by Cem Karsan. Many of you may know him from Twitter, along with his friends Gary, Vanna, and Charm. So I got the real Karsan here in the background, but we got Cem Karsan, who's a former market maker, AKA from the institutions. He's got 20 years of trading with a focus on volatility. He's the founder of Kai Volatility. So welcome back to Pounding the Table, Cem.
Good to be back, guys.
So we had a ton of questions since we last spoke. You know, everyone has been following you on Twitter and always very confused, like who's Vanna, who's Charm. So before we get into some of that and the nitty gritty, you know, I asked Tony this on the very first episode of Pound the Table, just understanding, you know, what does the day in the life look like? So I'd love to hear from you too. Like, you know, from the moment you kind of wake up, you don't need to go in too far of detail, but just really understanding how you prep, you know, and how far in advance are you looking? I know you're dealing on the very macros. So I don't know how much influence some of these breaking news stories have. And, you know, how do you go about that from a day-to-day perspective in your world?
Yeah. So that's a great question. So, you know, I'm always up pretty late. Most of my followers in social media know that. I'm usually up through the European Open. That's a big kind of moment for kind of vol. Always has been. You kind of see a big shift there. There's always great opportunities for that. So we definitely have a guy trading around the clock and watching that. But it also kind of informs me on kind of how volatility, how skew are likely to be moving and trending going forward the next day. Usually hang it up after I kind of do a little bit of either journaling or kind of writing down. That's kind of how the social media thing started for me. Honestly, I was really me writing down my thoughts when I started to kind of, doing that to a broad audience keeps you honest, right? You have to believe what you're saying. So that's kind of how that started for me. And that's always something I've done is in the evenings before I go to bed to kind of put that down on paper. And then, wake up around 6:30. I got two little kids, 10 and 8. And so spend a little bit of time with them in the morning before I'm out the door. And then, in the office, generally around 7:30, 8. So I'm on the later side. I have guys in starting at around 6:37. And then we're, we have a morning meeting. We're talking about the day's events, where we see kind of all shaken out, what the opportunities are for the day, what our indicators are like, how we see kind of our vol distributions and our directional distributions. If there's any adjustments we need to make. A lot of that's automated, but there's a lot of also kind of discretionary kind of elements to adjusting factors that can't be modeled. And then we're off for the trading day. Usually spend the first hour on the desk with the team. And then, it's on to kind of other things throughout the day, as long as it's slow. Check in throughout the day. We have kind of multiple kind of Slack kind of, back and forth between different teams here. And so if I need to get pulled in, I get pulled in. But for the most part, I try and kind of be in and out and not in too much until, again, around 1 o'clock. 1 o'clock, I'm back in really to the end of the day, talking about and rebalancing kind of the book and working through what's next for the day, getting ready for those end of the day flows and things that matter. Again, if it's busier, I know during really busy times, I'd be a more full-time on the desk type situation, but it's been obviously slow now kind of for a while. All things considered, a lot going on, but relatively slow compared to kind of the really hectic time. So, and then end of the day is investor calls, communication, more business related, and working on kind of the business development side of things as well. Sometimes that even includes a podcast. So, that's kind of my general cycle a day. It doesn't stop on the weekends. Definitely, work a couple hours on the weekends as well. Some of that's business development. Some of that's working kind of big picture with quants and on the development side. Yeah, I think that's the general flow of things.
And while you're, laying in bed at night tweeting, other people are staying up in bed all night thinking about what are all these emojis. So we'll definitely be getting into that on the podcast really soon.
Before we jump in though, real quick, I do want to stop and I just want to understand how these kind of the algos and some of that automation you were talking about works, right? So like going back to the question, like then, obviously there's once in these blue moon events like 9/11 or, some Afghanistan, for instance, like how does that work into some of those algos? And like, how do you make that change if you need to? Is that manual or is the algos pick up based off the volume and such?
Yeah. So, it's always a work in progress. So, but our broad product is really looking at volatility surfaces in real time and understanding we have a connection between those surfaces that we're looking at. That's kind of a bit proprietary, so I don't want to dive too deep.
Sorry, of course.
But
tell us everything.
Yeah. Essentially, we're holding our our surfaces in real time and our surfaces relative to one another based on. Again, we kind of take a unique approach with using both bar factors and kind of parameterizing the surfaces. And I'll leave it at that. And so we have that kind of robust market maker framework, which is giving us a residual at any given time, what's high, what's low, and how does it, what do we think, how that's going to revert to the surface. That's kind of one of our sources of edge. The other one is, as everybody kind of knows at this point, this dealer flow piece, which we're really measuring kind of, what's positioning like across the different products and what does that likely mean for outcomes. So there we're drawing distributions that again is in real time. We're looking at weekly distributions with daily path. So it's not every second, every minute, not yet, at least. Like I said, it's an evolution. I'm sure we'll get there as well. But we're really, looking at weekly distributions of outcomes for underlying as well as volatility surfaces. So each surface itself, and then we take those and put those together, and you're able to kind of find your best opportunities, both in terms of your predictions as well as kind of your real-time relative value opportunities.
It's a really good understanding of what that is. Awesome. That's a good question, Avi. So we got Jackson Hole Symposium coming up on Thursday, and Friday, the big man, Jay Powell, is taking the stand. So we've got a lot of FinTwit watching that as, David versus Goliath is going on there. The small retailers waiting for the big boys to determine our destiny. And, they've been hinting at it for the last few months now, what's going to be happening, maybe not in the last few months of the year here. So definitely want to touch on that as well.
Yeah. What is that? Because I go skiing in Jackson Hole, right? And like, obviously the financial moguls aren't going down moguls, right? What is the Jackson Hole Symposium? I think for a lot of the listeners out there.
Oh, it's just an annual kind of get together of who's who in monetary policy circles. It's really it's an important way for different Federal Reserve heads and kind of broad the inner workings of each government to kind of get together and coordinate, really. So it's an incredibly important moment on the world stage. Matters more when there's more need for global coordination. Obviously, the Jackson Hole back in 08, 09, I remember being like, huge meetings in particular, really kind of turning things. Right now, obviously, it's also big because we're at a big moment and monetary policy is really at an inflection point. And so, as we all know, the tapier is coming through town, right? And so, the question becomes, are we not? And when? And how quickly? And so I think everybody was ready for it to be more accelerated based on all the commentary up until about a week ago, right? And that's when Kaplan kind of came out of nowhere. Kaplan's kind of the big hawk that, he's probably the most hawkish and really came out and threw a lot of cold water on the fact that was going to be accelerated. He pointed to the Delta variant as being, the primary driver of why he felt it was, they didn't want to accelerate too quick and they wanted to kind of push it off. So now, and that was, I think, a big part of, this bounce that we're getting, right? There's a couple of different hypotheses of like what's driving this, that what drove that 2-day 120 point rally. My understanding, and I think a lot of people that are kind of on the institutional, side, is that there's kind of there's some information out there about what the Fed's going to be doing, and then Kaplan came out and announced, right around then, right? So not a surprise there. That might have been a big part about it. The other news that's kind of floating around that I'm hearing is is potentially steel tariffs coming off the table by government too. So that might have been something big. A walk back of tariffs with China would be a huge move for the market, given particularly how oversold China is and that area. So that's something to be mindful of and to be watching closely as well. So there's little pieces of information out there that the infrastructure plan might be getting pushed through very quickly as well. So there's a lot of right tail events right now that I think people are kind of we're sleeping on for a little bit. Everybody's so worried about the taper thing that it kind of all of a sudden I think people realize they may need to be front running the other wing. And I think that's what we saw. But specific to Jackson Hole, my guess is based on not only the price action of the market, but really kind of some of these big info broker kind of trades, that there's a high probability that it's going to be less hawkish than people expected just a week ago, and that we're really going to get a dovish outcome. And so we'll see. There's either way, it's coming. November, December, January, right? Most likely, unless something changes dramatically. And that's still, whether it's whether it's then or a month before or after, that's something important to think on the macro scale. And so, may not get that pullback here in September that people are always hoping for. And if we don't, you get to end of the September quarter with those big JP Morgan trades again, into October, November, December, which is great, much more seasonally supportive for obvious reasons. And things may be tougher to get that decline into the end of this year. So, so I think that's a lot of kind of the perspective that changed here around Jackson Hole.
How do you, as a retailer, we don't have all the quant and all the algos around us, but like you mentioned with JP Morgan, but like, is there any indicators that we can kind of keep an eye out for that says, hey, it's not next week, but it's not, and maybe the end of September? Like, is there anything anything you can share, I guess, that we should be kind of keeping an eye out for?
I mean, look, there's you should always watch big orders. You should always understand to the best you can, who they are, and try and characterize them. That's always a source of edge. You should understand, and that means both things that are predictable, like that JP Morgan trade, right? Mm-hmm. And what that means. You should also, it also is like those unexpected things like Carl Icahn, right? That was an opportunity. Those things need to be taken seriously and need to be put into your models. They mean things. They are information for your prediction. But there's also a lot of what I talk about, all the dealer flow stuff, like being able to track that more broadly and have a broad understanding of when that positioning is out of whack. And also, looking at when things are, when retail positioning is even, right. Understanding, watching things like put call and things like that. Any information that you can gather that really gives you a sense of who's where and what part of the market and what that positioning looks like is my primary focus. Right. And I think, I look at the world at supply and demand, and that's the key. And that sounds overly simplistic, but it really is what moves things. I think the more we get into this, like this what news has come out and what does that mean, and speculation about what that means about, other than the Federal Reserve and the Treasury and the dollars and that they're providing to the system. Everything else to me is kind of noise, and so I try and cut through that.
Absolutely see that. Every time I see the ARC put call ratio go very, very high, I know that that's probably not when it's going to go and do the horrible drop everyone thinks it's going to do. So I wanted to touch on the indices for a bit here, because obviously the S&P, I think today reached almost up 20% for the year, and they've been running high all year. And it's pretty clear, though, that a lot of the names, it's just only a few names that have been getting the majority of those flows. I think breadth's been not so great for the general market for quite some time now. And as you said, it's the market's like chugging along, but it's, not much is really going on. We're just kind of trending higher. So definitely want to know your thoughts on that, and whether or not, if there's going to be a taper, if that's going to be affecting those bigger names that have been getting all those flows, or you think you're going to see money flow into the names that maybe got sold off too much in anticipation of it happening more rapidly.
Yeah. So, early on in this year, and obviously last year, we were very aggressive about how we thought the next 10 years is going to play out, right? 10 years, we still believe very strongly, like 5 years is going to play out, right? Even multi-year. We still feel very strongly that, a normalization of interest rates is going to lead to, multiple contraction from the growth sector, right? And really, start valuing discounted cash flows. Obviously, these things don't go in a straight line. And obviously, the Delta variant, right, and the speed of reopening has been way slower than anybody expected, ourselves included. And that's led to, particularly internationally, right, we're almost on track here, right? But internationally, it's been incredibly slow to reopen. That's led to supply chain issues and all kinds of other things that have slowed the broad reopening. That paired with a slower infrastructure spending plan, like again, we thought that would come through pretty much quicker. That's been a bit slower. Our view is that broadly that's actually really even more bullish for rates long term and ultimately kind of this rotation. That's the reality is we're getting probably more for longer because of that, right? And it would be really hard to kind of push a lot of this through if that wasn't the case. To put it in perspective, I think we talked about this last time, but we're going to be after this $3.5 trillion, assuming it goes through at about $10.5 trillion in fiscal stimulus. The New Deal was $1 trillion, right? We talked about this, I think, last time. The Obama stimulus in 2009 was $1 trillion. Again, these are adjusted in real terms. So we're an order of magnitude bigger, and about $1.5 trillion of that has come through the pipe so far, and that's been filling a hole. So the question is, when is the reopening happening? When the reopening happens, there's two major effects. One, all those dollars that are in the market are going to get pulled out and put into the real economy, right? So you're going to get more and more of that. That's one. Two, the more it goes into the economy, the higher rates will go, in theory, right? Because you have growth. We're already seeing massive growth numbers, right? Imagine when we're fully reopened, right? We're seeing 6% growth from all this demand side economics, right? So, when that really gets going, if rates at the longer end start going higher, which we still believe will happen, it won't happen overnight. That's a secondary effect, right? That's going to pull away from liquidity. Remove some of the banana supply from Gary and get the, and really be a problem for some of these kind of names. Breadth is a problem long term. It's going to continue to be like this. Is not going to happen overnight. And we do see that as a warning sign, but it's not a short-term warning sign. It's a more kind of macro picture warning sign. It makes sense relative to what we're seeing. That these names are also kind of flying, but it won't. Again, as soon as that liquidity kind of starts being removed, that's kind of your sign to really start leaning on it. So, to answer your question, I think breadth is a long-term problem, but it's not a short-term indicator in our view. Whether it's September or next February, right? Where we're in a window to be broadly much more cautious, but that doesn't mean we won't have a blow off top. And I think we're in a situation where the wings are getting very, very fat, very leptokurtotic, and you really want to be playing for both left and right tail. I mean, anybody that was around 99, 2000 knows the best trade to put on into that last bubble was long call upside calls, right? You made that last year and a half tremendous amounts of money on being long vol into a rally, and vol should continue to should rise into that last leg of a rally. That's what I would be looking for. The more we start getting to that point where the rallies are bigger, more consistent, and the right tail is leading to higher implied volatility. I think that would be really your kind of 3 to 6 month warning shot to be prepared.
Is it going to be that blow off right away, or is it going to be that slow, steady starting to come back down as the last soldiers are falling on the battlefield? That I guess we'll have to find out and wait. One thing I do want to ask though is I know you have this multi-year perspective of rates going higher. I agree with you, and so wondering whether or not all the innovations in technology, how will that be impacted, right? I know the Elon Musk robot, right, for instance, stuff like that, right, automating, that's all deflationary and other things like that. You have these companies now where I was reading a book, I forget by which investor, saying that we used to have companies that don't have 80, 90% gross margins, and now we do. So there's a lot of differences in terms of how you can actually value a company. So I was just wanting to know how you kind of factor that into your long-term macro projections for maybe the individual stocks or sectors.
Yeah, that's a great question, Tony. I think the reality is macro. There's lots of different timelines, right?
Right.
If you really, really back up and look at kind of what happened in the last 40 years. And again, I've talked about this, but the supply side economics, cheap money has led to basically free capital for corporations, essentially free to bet on very long-term outcomes. Right? We wouldn't have had an Amazon or a Uber or any of these companies if they had to make money year to year. They were able to not make money for 20 plus years, right? In some instances, to be able to bet on the total, capturing the big piece of the pie, so that then they could eventually make money. That spurred an industrial, technological revolution, right? There's no doubt in my mind that the technology and the speed of technological advancement has been intimately tied to monetary policy. And I think the reality is the more we start to move away from that, longer term, right? Now this is going to happen overnight. You're going to begin to have some creative destruction. You're going to have small companies who can't generate short-term income, right? That will die on the vine, right? And you'll kill future innovation and future opportunities. Bigger corporations that have now made it, right, like an Amazon or an Uber or whoever it is, right, that can produce profits now and can survive, will have the benefit of buying some of those smaller corporations, helping use it. So I think it's going to be very, it's going to be, we're going to get even more monopolistic kind of, trends going forward. But it's also going to, stimulate kind of innovation broadly. Cash flows are going to become much more important. Companies with cash flows are going to be able to purchase other corporations and other technologies and fund some of those ideas. And this is the way the world used to work, right? I think there's a fundamentals will matter again at some point when cash is not free, right? The value of money will go up. And so when that happens, I think you'll get that rotation back. Now the question is, how long does it take for some of that that money in the system to kind of ebb off, and how quickly does that happen? I mean, the problem is we're so stretched in certain terms of the capital. It doesn't take a lot to at least get the bottom layers of companies that won't generate profits for 20 years to die. And the question is, once how quickly does that unwind happen, right? Where you get that creative destruction, where entities are having to sell off assets, and then valuations decrease, right? And then there's fear, right? And the bubble starts to burst. People start backing away from providing money as cheaply, right? Et cetera. So, that's how all these cycles kind of unwind. And this one in particular is incredibly stretched due to 40 years of monetary policy. And so the question becomes, how is that going to affect, and how quickly is that going to affect these technologies and that deflationary effect? My view is that it can happen much quicker than you expect, right? It may, it's kind of, what's the famous quote? Like, nothing happens for years, and then it all happens at once. I forget what the quote is, right? Like everything happens slowly and then happens almost overnight. So that's my experience with things. The sands that are supporting things are slowly getting less and less stable, right? And at one point, that will all kind of something will set it off. We don't know what it is, and then it'll happen pretty quickly. But whether that's in 3 months or 9 months or 2 years, I can't tell you.
Whatever the most ironic outcome will be, right?
That's exactly right. Whatever the most irony. Difficult outcome for everybody, right? It really. I was having a conversation with my team. Like, it's really the general new best factor we have added to our model is whatever the hardest position is for all parties at any given moment is the most likely outcome.
Loves irony.
Yep.
Yeah, exactly. No, I mean, we always talk about this too. I always say, like, I use Salesforce as CRM as like one of these big oil tankers where a lot of these high growth startups like you're talking about, where, they may get wiped out with the big wave. And, when they come over, they're like little jet skis that will get crushed. Where meanwhile, some of these bigger companies will be able to stay afloat, I think.
That's right.
We got a few questions here from the audience. I know we touched on this a little bit last time. So if you did hear, Cem last time, fast forward a minute here, but, talking about the Greeks just a little bit more, before we kind of just butter the croissant, if you will, so for some of these newbies, right? Like the options of these Greek flows, right? So, you use these fun names like Vanna, Charm, et cetera. But understanding like, what are the most important ones? If you're like, 101 for some of these folks that are just tuning in or don't really have a ton of knowledge about what the Greeks are, which ones, are the most important, and how do you kind of watch those?
Well, everybody talks about gamma, right? Like gamma is it's the simplest one to measure. It is, basically vol supply. It's the thing that pins the market and creates or unpins the market, right? Broadly. It's the more exciting kind of sister of the group because ultimately, it's what governs the tails, right? When gamma gets really short, it's when things can really, like Feb March of 2020 get pretty convex. So that's important, but on a day-to-day basis, and I've talked about this before, that's in my view, much less important. It's something that matters, 1% of the time or so, in the sense that it's when it's undersupplied, right? It matters in the sense that it's broadly supplied and things are being really pinned. But in terms of actually prediction and direction, the bigger and more important part for me is really this, Vanna and Charm, right? And the reason I talk so much about those are, that's really a function of insurance being unbalanced. The markets are unbalanced, right? Markets, people are broadly long. Like everybody, you've heard me talk about this a million times, right? But if you eat, you sleep, you breathe, you own a home, you have a job, you're long, right? And the stats are as follows: there's $80 trillion of domestic equity, long markets, assets. There's $450 trillion of assets, long assets in the world. Okay. We're talking massive amounts, right? If you talk, that's if you had PE and real estate and everything together, right? That's the amount of assets. The hedging in the market is less than $500 billion, right? And it's a tiny, maybe $1 trillion if you really stretch. So you have this massively unbalanced thing. And what happens when that $450 trillion of long assets needs to hedge? There's just not enough liquidity. There aren't enough participants to absorb that liquidity. And that's what leads to option market skew, right? And that's also why these valuations, option market skew, is as dramatic as it is. It's not only the highest in the US relative to any other place, it always is, but it's historically at the 99th percentile. And so that instance creates this massive carry trade. Right. At the end of the day, you have a massive insurance market. It's the biggest insurance market in the world. How do we all hedge ourselves against, the biggest risk to ourselves other than life and death? It's our assets, our power, how we're going to live and survive, how we're going to feed our families. Like, how are you going to protect that? Right. And ultimately that insurance market leads to a feedback loop, a reflexivity to broad markets that is endemic to how things work, how the whole system is run, right? And that's the risk reward of markets, right? And it can be measured in dollars and cents via these insurance contracts, these S&P puts, or any other puts that you want to look at for the broad market, or any other risk premia, right? It can be measured that, and those risk premia are growing, and the effects of them, right? That people who are selling them or using that being insurers, right? Capturing this risk premia are ultimately going to have to hedge those to manage those, and so that feedback loop is Vanna and Charm. That's what those are. right? From a 30,000 foot view, that's what's happening. And that's why it's so important. It is the market. This isn't like a characteristic of the market. It is the market. This is what drives the market structure. And that's why I've talked about, all the adages that you hear, right? About, never short a dull market. Why? Because the market, there's buyback on the insurance risk premium decay every day. Whether you call that Vaughn or Charm or what you call, there's buyback every day that pushes markets higher. There's, the escalator up, elevator down, same thing. Markets kick up every day, but that insurance, ultimately, there's not enough protection on the tail. Ultimately, you're going to get kind of gamma feedback loops for that hedging. So this is, again, so to answer your question, that's a long-winded answer. Vana and Charm are the most important ones. Options market skew, that feedback loop on a day-to-day basis is critical to understanding how markets work, and really using that in terms of prediction and modeling your distributions.
Love hearing that point about like how unhedged people really are, because it's funny. You see the market just slowly trend higher, and these SPX puts are like, very, very cheap for the dailies or, 2 days out, a week out, whatever. As soon as we start turning down a little bit, you see the next expiration is just, it goes $20 at the money, $25 at the money. And then of course, that's when it doesn't keep going lower, because $25 at the money has already been priced in. It is that endless cycle like you're talking about. And we actually had an interesting question from the audience at Elon the Musket. I like that name. Make sure Cem elaborates on volatility other than short VIX due to high contango and the forward future contracts that the institutions have to unload before every monthly OPEX. So maybe that's another way to kind of talk about what is the market, not just some characteristics of it.
Yeah. So important to, I don't know if I'm going to cover this exactly, but other than, obviously the kind of the skew dynamic, which I think, I just covered, is, the actual contango of the curve, right, is a major feedback loop of this Vana and Charm as well, right? Because you have, as the Charm time passes, you're also getting a massive decline in the vol, right, of things towards expiration, which leads to kind of that Vana feedback loop. Mm-hmm. You're also getting Veda, right? You're decaying longer and longer, vol. And as you get longer and longer vol, that causes more and more vol compression, which leads to even a second order kind of Vana effect where the whole curve comes down, right? So my point is these are all connected. I don't know if, that's really answering his specific question, but the reality is like, the point here is all these dynamics are tied up together. It's not just a passage of time or kind of a cyclical thing based on expirations. It's the fact that once a loop accelerates, right, a lot of the reflexivity gets into motion, and the opportunities really lie in those reflexive loops that happen, both in winding in and tightening, and also unwinding when they eventually happen. So I don't know, again, if that answers the question specifically, but these are the macro flows. If the question is how does this relate to different products and different opportunities? There's a million different,
right?
There's million different angles.
I'm just nodding my head, pretending like I understand half of what you're saying. I'm going to have to listen to this back. I did this last time too. I listened to like 5 times on our last one, and I was like, oh, I think I kind of understand this a little bit, but I'm going to have to do the same thing here. You were talking about like, obviously everything feels good until it's not, right? So like, and again, this is not putting you on the map of like, what's your exact prediction, but like, do you think, that we had this once in a lifetime, hopefully, event with COVID, right? Do you think the next correction, is that going to be a 5%, or do you think it could, really crash the market? Is there any way to kind of get a sense of that from what's going on right now?
My view is that the tails, this is an important point. I've made this before, but I think it's really important that the amount of leverage in the system is beyond historic, right? Like we're at a massive extreme. And I think that is probably the most important thing that you can kind of internalize when you're looking at this market. Leverage creates massive support, right? Massive supply of this is ultimately the money supply, right? That leverage, that amount of capital that's available leads to a lot of buying the dip. That leads to vol compression locally. It leads to risk premium compression, right? Leads to chasing and compressing risk locally, right? Locally. So it really narrows distributions, right? But ultimately, it fattens the tails dramatically. Because at the end of the day, if you have an event, if you do become unpinned, that $450 trillion of assets does not have liquidity that can absorb it. And so I think that's critical for people to understand. So many people are talking about how skew is so ridiculous these days. Even the vol space, people who look at them as hard numbers say, oh my God, I can't believe this skew. This is insane. This doesn't make sense. This is a sale. But the reality is the tail structurally is so much fatter, so much more risky, right? That doesn't mean vol is a bad sale, right? But it means the tail, the skew is incredibly cheap, in my opinion, despite how high it is historically. And I think that's kind of the critical thing to take home is the way you want to structure your portfolio is really to be long the tails dramatically. So you can take risks, lever up long if you want, like do it, but you better be levered long the tail. That gives you a big payout into that convex payout. So to answer your question, what's the next big one? It's either 5% or it's 30%. It's not in between. I think, and again, can it be 7%? Sure, right? But my point is, it's either relatively contained, or it's not going to be 12%. It's not going to be 15%. It's going to be, something contained that eventually leads to a really quick buyback and right back up, or it's going to really unravel. And that's kind of how markets have been now for a while. It's only increasing though, right? And in my view is we'll probably get again some unpinning of vol really to that upside in that upside move. Right. At some point, that unpinning of vol will ultimately lead to that local vol being loose enough for us to get out of that 5, 7, 10% move down to really get that kind of that real move. And that's what I think will ultimately, and what historically unravels kind of the bigger, more macro picture, kind of accelerates some of that creative destruction and other things that are more macro, longer term flows. So hopefully that kind of gives you a broader picture of how I kind of see the world. But yeah, that's why markets tend to do these things that they do. That's why I think we'll probably get a blow off, right? It'll be really hard for this market to ultimately have a decline until we really unpin that vol. And that tends to happen with it just getting too cheap to the upside into continued rallies.
Yeah. So if you're going to be levered long, make sure you have an Ackman trade that can take you from 26 to 2.7 billion. So
that's right.
Exactly.
Right.
So I just have a really quick question, probably our last one, unless you have anything else you want to add. I know a lot of people, at least a lot of the followers we have, they love trading options. And I think a lot of the time people like to go way shorter on expirations than they necessarily might need to, or they'll just, they'll buy just not the right strike. So maybe if you have, like a very quick way they can start to think about what kind of time frame they should be, looking at options for, if they're selling or buying, or, maybe they should be creating spreads in certain times versus just going naked calls all the time, and just YOLOing AMC options. So definitely want to give the audience a little bit of your expertise in that regard, because I know that options trading is at an all-time high for sure.
Yeah. Yeah, no, absolutely. And you probably heard me kind of talk about this, but I think this is a good kind of venue to really kind of expound upon. Options are the underlying asset. They are ultimately the expression of all of the distributions of underlying outcomes of every asset class. They both look at time and probability, right? And that three-dimensional view of the world, that because time matters in an asset portfolio. People don't think about time. So often people ask me, what's the beta of your portfolio? Like, well, are we talking a daily beta? Are we talking a weekly beta? Are we talking about an annual beta, right? Because if the market declines 20% tomorrow, that means something very different than 20% over the course of the next 2 years. And so I think understanding that probability distribution and being able to then bet on what the different information means as a function of that probability distribution is incredibly powerful, right? And so few people understand that. Now, I think a lot of people in retail are betting on these outcomes, which tend to be tail upside outcomes, right? And they're getting the benefit of betting on a small part of that distribution with high leverage, right? And they love that optionality, if you will, right? But I don't think they fully realize necessarily. I think they're getting the benefit of betting on that distribution. They don't fully understand why, but I think this understanding is broadly, the benefits are pretty clear of options. And again, a stock or a bond are just a summary of all of that information. Long, short, right? And everybody's always asking me, well, but are you long or are you short? Or I don't get it. I don't get all this distributional stuff you're telling me. Should I be long or short? Well, you know what? There's much more to it than that. There's much more. Maybe you want to be long the tail and dramatically long the tail and short at the money vol, right? Like we just discussed, right? Maybe that's an incredibly profitable trade. That makes money in much higher risk-adjusted returns than anything else that you're talking about. You don't have to just look at the world as long or short. So I think that's where I'd start for all of your options traders, is start with probability and understanding what do you think is going to happen, but not just today, up or down, but in terms of time and in terms of moneyness, in terms of probability of those outcomes, and start making your options bets a function of that, right? And that's what's going to get you to a point where you win much more relative to your risk. That's how you become a real vol trader, a real options trader. And that's how what everybody should, in my opinion, be. That's how everybody should be looking at the world. If I move forward 20 years from now, options are a vastly superior product. I don't see stocks and bonds being as important as options ultimately. You have a much greater amount of flexibility, a much greater ability to kind of leverage and manage risk when you're dealing with the full distribution. So that would be my parting wisdom.
No, that's super interesting. And Tony, I feel proud that you've kind of taught me about the vol ball initially. And now what Cem's saying kind of makes sense to me a little bit more. Last thing, I know Tony said the last question, but I know, last time we had a bunch of questions about this too. The white paper on Charm, mentioned it's almost like detox, like everyone's waiting for this Dr. Dre reference. I don't know if you know, but in terms of where that's at, I know that you mentioned, previous show that's coming down the pipeline and you got a lot of things going on. So would love to hear too, you got your new fund here with Kai Volatility. Would love to hear, if you guys have any cool products you guys are releasing or what you guys are focused on now to kind of wrap it up.
Yeah. No, I appreciate that. No, we've had extraordinary interest in the products and launching the new ones and everything that comes with that. Obviously, you're kind of drinking out of a fire hose for a while. So the Vana white paper is coming. I'll keep teasing it. It is definitely going to be, it will go over all the multiple layers and how we see it all connecting. And I think that'll be great when it comes. We also have a couple of things like we talked about, that fixed strike vol ticker and a few other things that we were really excited to kind of to bring out in the months to come. But I really think that's probably 3 to 6 months from here. We're really focused on getting the returns and everything for the new products to where they need to be. And everything's great. We're and dealing with all the kind of new investors and focusing on our knitting in that regard. But there's a lot of exciting stuff coming to the pipe. We're going to have an educational platform, which I think will be kind of the intro to all that other stuff. But I would expect in the next 6 to 9 months, it's going to be an exciting kind of rollout of one thing after another. Really kind of continue to educate, continue to bring people into kind of the croissant bakery.
Yeah, I love it. You've been an amazing guest now both times, and such a refreshing voice on FinTwit. It kind of you're a little bit out of the echo chamber. You're kind of in your own little hemisphere, I always say, and try to decipher anything that you're talking about. So thanks so much again for coming on.
Pounding on the table for my team. Every night I flex. I'm making big money.